Good afternoon, everybody. Why are we wasting time in talking about alternates when all the fun has happened in the equity markets, right? Everybody has seen the kind of money people have made in the equity markets, but as the saying goes, nothing survives for a long time. Everything has its own place in different market cycles. We are lucky to have three fund managers here, who will be sharing their thoughts about the market and what they see, what has happened, what is happening, and what they expect going forward as well. Very importantly, we are not trying to give any tips or what will happen in the market. So I think when we have a Q&A, we can pardon those questions and maybe have more questions relevant upon how portfolios will be constructed with equity. What we want to cover today is very simply about what the market has seen in the last few years, what kind of risks are there in the market, what we should be cautious of, and how each fund manager is building a thought around building their portfolios and what they're looking for the next short-term and long-term as far as their funds are concerned. Since it's a power-packed panel, so people may have different views, so please feel free not to copy anybody and have your own clear views. We are an RIA, so we say our heart out, so we don't care about what others feel. I think just starting with Madan, you, and the question is for all the panel members. Last 4 years have been really, really nice for the industry, right? Everybody's making money, whether advised, not advised, or good distributors, bad distributors, but I think what you should understand how in the last 4 years, what you see happened in the market actually beyond the headline numbers, what you saw major changes happening, which gave us this kind of a good rally that we have seen in the last 4 years.
Thanks, Munish. Good afternoon, all of you. Last 4 years, we have seen a tsunami of flows happening. Initially, I think it started with global liquidity easing post-COVID. And then it was supported by the FII passive flows, and then domestic flows, and then of late we are seeing the thematic flows, right? So there is a tsunami of flows that has happened. Whenever such flows happen, we have typically seen the narrative taking a lead and data taking a little bit of a backseat. So narrative definitely has played and helped a lot of investors to whoever has oriented towards playing narratives have benefited more in the last 3 to 4 years or so. Typically, I explain this with this investment versus consumption cycle. If you look at in the past, this love story between L&T and HUL. Between 2004-2008, L&T from being an underperformer became a massive outperformer from a 30 times PE to almost 100 times PE. In the same period, HUL actually did not do anything, almost gave just, say, 30-40% return on an absolute basis over 4 years, and was trading at some 30 times. After 2008 till 2018, L&T literally stayed where it was, did not generate any return, while HUL gave some 2-3 times return from there. So this cycle again changed between 2019 to where we are right now. If not by L&T, other capital goods companies have given sort of returns what L&T gave in those periods, while you have seen defensive staple companies struggle for returns. So this is what has happened in the last, if you look at purely from market cycle perspective, in our opinion. Importantly, if what is in the price was always questioned throughout this last 4 years. Companies which have surprised, which have grown by 5% but have now started growing at 10%, got rewarded much more than companies which have been growing at 20% and continuing to grow 20%. If it is already in the price, I think nothing happened in those stocks. But companies even with lower growth but surprising have got rewarded handsomely. So I think this is likely to continue for some more period, in my opinion. So a portfolio should have a reasonable allocation towards surprises, where the surprise comes from, either sectoral outlook or through valuation. This is something which will keep happening for at least another 1 year or so until the flows continue. So that's something which we need to be, that we have seen, and what changes that we have also made in our investment approach.
I'm sure there needs to be an alternate product just looking at the flows, right? Some algo to run on just the FII flows and domestic flows as well.
Obviously, you have to take a little structural call on flows. If not, actually keep tracking it. If you feel that flows are going to continue, then I think some amount of allocation towards earnings surprise stories is important. But what I feel is you got a lot of earnings surprise last year because of the commodity tailwinds. Going forward, it's going to be very rare. So then what do you do really? You can't really play a full portfolio approach towards only opportunistic. You need to have, you need to be careful about it.
True, true, true. Sandeep, what do you think? What your take on the markets for the last 4 years is?
Sure.
Sorry
Thanks,
for
Manish.
4 years, sorry, but it's because of the pandemic. That's the only reason why equity should not be invested for less number of periods.
Sure. Thanks, Cafe Alt, for the opportunity, and congratulations for a great event to Prem and the team. So, Manish, I will add on to what Madan has said, and there are some differing views as well. If we look at pre-COVID, like Jan 2020, the market levels were approximately 12,400. I'm talking about Nifty. Let's take it to be 12,500. Today, the market levels are, let's say, more like 25,000. So Nifty has about doubled in the last, let's say, your question is more like 4 years, but let's say more like 4 to 5 years. If you look at Nifty EPS, that was more like 450 in 2020. Obviously, there was a 15 days impact due to COVID. So let's say more like 475. This year, Nifty EPS is more like 950 plus, closer to 1,000. So actually, earnings have also doubled. If we look at GDP size of India back in 2020, was something more like 2.6, $2.7 trillion. Let's take 2.5 or so. Now the GDP size is more like $4 trillion. So there's an increase of, let's say, 35% or so. So the fundamentals of the economy have also significantly altered in the last 4-5 years. The narrative for India is significantly better today, especially in a relative global context, let's say versus China, than it was pre-COVID. So yes, there are flows, but there are numbers as well, I would like to believe. And there's a very strong narrative, whether it be due to China +1, Europe +1, etc. Also, in some sense, over the last 4-5 years, we've seen the government come on its own. And we've now seen a continuous period of maybe 10 years of reforms, maybe which the country has previously not experienced for such a length of time together. And that has propelled a lot of capital intensive sectors. It could be infrastructure, it could be manufacturing, it could be defense, it could be energy. And we have seen PSUs being at the forefront of the investment cycle. So while households to some extent were battered, but we have seen this trend of a lot of investments in these sectors. So I think this is a big change that we've seen over the last 4-5 years. Also, another change is the capital raising that has happened in the economy, which is kind of setting the foundations very well for future growth. So banking balance sheets are in a far better shape today than they were, let's say, 4-5 years ago. Corporate balance sheets are in a far better shape today than they were, 4-5 years ago. So that also sets a good stage for investments going forward. So in my view, these are the major changes that we see in the economy, and parts of it have also been reflected in the markets.
That's a lot of structural change that we have, I think, perceived in that space. Dhiraj, knowing you have a bit of a different take on what has happened. It'll be good to know your thoughts on it.
Yeah, so I will just continue from where Madan and Sandip left. So as Sandip pointed out, Nifty was 12,500 in 19, and it's about 25,000 today, so doubled. So that's a CAGR of about 14 or 15%. So if we actually think about it, it's not very different from what our long-term return trajectory is. But it feels more bullish than what the market has delivered, right? And that is because one segment of the market has done significantly better than the Nifty, or few segments of the market have done significantly better than the Nifty, so which is mid and small in terms of market cap space. And in terms of capex-oriented businesses, either it is power or defense or PSUs. And that is what, giving that impression that the market rise is sharper than the 14 or 15% Nifty compounding. Both Madan and Sandip interestingly use the word narrative repeatedly. So my favorite statement these days is the India narrative is so strong that if GDP grows at 6, it feels like 9. It's a little bit like New York weather when he says temperature is 30 but feels like 22. So yeah, India narrative is strong, and narrative is actually important to drive valuations. So we always think of markets in terms of earnings, but there are two determinants of returns. It's both earnings growth as well as valuation, derating and re-rating. Valuation, derating and re-rating is part science and part art. So it is science because valuation is derived from cash flows and earnings, but it's always a range. I mean, is 20 times the correct valuation for Nifty? Is it 25? Is it 28? Who knows? It floats in a range. And what determines the range is what the narrative is, how confident is the country, how confident are the investors feeling about the nation's future. So, I mean, there are batchmates debates over a drink or sometimes on WhatsApp. You try writing something negative on India and people just pounce on you, right? I mean, that's how strong the narrative is. Even if factually you are right, even if factually you say, here, rural demand is weak, income and it can't be that. So the narrative is very, very powerful and plays a role. So narrative affects the reality in a different way also, which is where do you put your savings, right? If you're feeling confident, you're more likely to allocate more of your savings into equities. If you're feeling less confident about the future, you're likely to allocate lesser allocation into equities. So that's a very important phenomena. Madan talked about tsunami of flows. Frankly, I don't see that stopping because all of us, I mean, I started my career in 90s and we used to write about how under-invested Indian saver was in equities. Only 1% or less than 1% of household savings was in equities at this point. Today, it's, as per the recent RBI report, at market valuation has gone up to 15% of financial assets, which means it's about 7.5% of total savings of Indian households. It's still too low. I mean, US is 35. Most other emerging markets are in the region of 20. 10 years ago, less than 2% allocation of household savings per year were going into mutual funds. Today it's 4.5. So it's literally rising at 0.5% a year. I think it can easily go to 10 and then 15. So this is not stopping. The other thing, my last point is Madan talked about, gave an interesting example of L&T versus Unilever. So basically he touched upon my favorite topic as I was introduced, which is I believe in market cycles. And there's, I mean, you could think of 10 reasons for market cycles, but actually it all boils down to or distills into one simple metric, which is are we going into a deleveraging cycle or a re-leveraging cycle? And the kind of businesses which does better, kind of businesses which grows faster, and kind of businesses where valuation expands or contracts, all gets derived from that. So Madan talked about 2003 to 8 period. That was a very strong leveraging cycle. Credit was growing at 28, 27% per annum at that point. Consequently, the balance sheet heavy companies and the companies which benefit from capital expansion like L&T did very well. Asset light companies like Unilever did poorly. 2011 to 20, we went into a deleveraging cycle because we gorged up too much on debt, too much of infrastructure debt between 2003 and 8. Most asset-heavy companies, including Larsen or PSUs or metals or whatever, they performed very poorly over that decade, and all asset-light companies like Asian Paints, Unilever, name it, I mean, they all did very well. 2020 was an inflection point. Munish keeps on bringing why he starts for the last 5 years because of the COVID break. Typically, countries, governments, societies, economies need a catalyst to change course. And 2020 was a catalyst where government just eased off the pressure on credit and leveraging. Banks were sitting on surplus amount of liquidity because LD ratios had fallen because of 10 years of deleveraging cycle, and the credit growth started again. So in the current 5-year period, we are seeing stronger growth once again by all balance sheet companies, and all asset-light companies are underperforming. The good news this time is that the credit expansion, while it is happening, it is at a moderate pace. I mean, credit is growing still at 15, 16% per annum. It's not doing 28% per annum like the previous cycle. Even companies are taking on credit at a very moderate pace. So debt equity ratio for corporate sector has gone up, but it's still in the 0.6, 0.7, 0.8 sort of range at an aggregate level. In 2008, between 2003 and 8, it went up from 0.3 to 1.6. So that was the speed of leveraging. So my sense is the cycle can last longer this time. It won't be a 5-year cycle. It could be a decadal cycle or higher.
So there are flows, there are real earnings growth, and then there are cycles which are all contributing. Imagine the investors have to keep all these things in mind before they're making their portfolio. I think just want to add one point here, and a lot of impetus or other importance is given to this headline index numbers. And in our industry, it actually has no value. Because just to take one example, 1 year back and today, I think the index has given you what, 20 or mid-20 kind of a returns. But the PE ratio trailing has remained the same. And on to your point, because the earnings have caught up, the headline index number has so no value. It is at 25,000 Nifty or 1 lakh Sensex, doesn't matter. It's ultimately the PE what you're giving. But a lot of impetus happens that now what next for this index and that. But there are such, such important things happening behind that valuations in the market we should look at rather than just the headline number, which is just a number culminating out of the collection of some stocks. Since we had 3 different perspectives on that, so I would assume that you will also like to raise some flag of risks in the industry, which because if flows stop, what happens? If earnings stops, what happens? If cycle changes, what happens, right? So what is your view on what kind of risk is there? Maybe I can start with Dhiraj, you. What kind of risk you think is right now staring the investors in their face? Maybe they're not conscious of, or they may be conscious of, but not giving so much of importance because of the last 4-5 years that we have seen.
Yeah, so there clearly are risks in the system which is increasing, right? And with every passing year and with every subsequent rise in the markets, the risk will always tend to keep on continuously increasing. So domestically, the risk at this point of time that one sees is that the earnings momentum, which was very, very powerful till 2 years ago, is dipping down a little bit, which I think Madan referred to in his opening remark. Would that risk by itself derail the market at this point of time? I have my doubts on that, simply because the retail investor, another favorite statement of mine these days is that retail investors have become price setters and institutions have become price takers. It's a
big change.
It's a big change. It's a reversal. So retail investors are saying, I am willing to value Dixon at 160 times. You want to participate? Your choice. You want to miss? Your call. So, and whether you can call it maturity or whether you can call it irrational exuberance, I don't know. But I think I'll call it maturity, because I think today's retail investor is not looking at 2 quarters and 3 quarters and 1 year. Today's investor actually believes in the India story, and to some extent, you have to credit the government for that, because the narrative creation started from there, right? So I don't think a little bit of earnings slowdown is a major risk, but the risk that I see lurking on the horizon at this point, and we saw a trailer of that on August 5th, is the global shift of interest rates. So 2 major shifts are happening at this point of time. Both are tectonic. One is Fed will start the rate cutting cycle, and Bank of Japan has increased the rate increase cycle. So which basically means that the yield spread between US and Japan will start to widen. And why is that relevant? Because Japan has been a huge supplier of capital, offshore capital. So just to give you some statistic, between 2017 or 2015 to 20, Japanese offshore investments was in the range, almost flat, in the range of about 250 trillion yen. Between 2019 to 2024, it shot up to 500 trillion yen. So an expansion of almost 250 trillion of offshore investments, which is about 1.5 trillion US dollars, largely because yen was continuously depreciating. It depreciated from 100 to 160. So there's a 60% return, just easy money sitting on your balance sheet, right? And whatever additional you made either on bond yields or equity investments or any investment you make is on top of that. It's a large number. And so this carry trade can very well unwind. There's a dual force. There's a downward pressure. There'll be downward pressure on dollar because of Fed cutting rates. There'll be an upward pressure on yen because Bank of Japan increasing rates. And this could create a global dislocation of the size which is a little difficult to put on paper and imagine at this point of time. But it won't leave us untouched or unscathed. So that's one big risk I see on the rise.
And we saw just a sample of it.
We saw a trailer of that on August 5th. One single day, topics was down 12%. Most of the Asian markets were down 7%. It was the single largest one-day crash since the Black Monday of 1987. And 1987 was what, 40 years ago or thereabouts?
True. That's a long time. Sandip, your view on that?
So, there are 3 points that I would like to make. In the first part, there are known unknowns, which is A is geopolitics. We all know the 2 conflicts that are going on. As long as they remain localized, I think it's, the markets have kind of taken it in their stride and, moved ahead, so it is fine. But if more countries get involved, it kind of spreads, then it could cause a problem. So that is, I think, risk number 1. Risk number 2 would be the damage that a high interest rate environment has done to the globe. So we've seen the highest interest rate levels globally that we've seen in the past 2 decades, because of which we saw a few regional banks getting impacted in the US in the first quarter of calendar year 23. We don't get to know these things. Even the Fed did not, US Fed did not know it, right? Only when they come to the surface is when we realize that these things have happened. So could there be more damages beneath the surface to the banking sector, to the corporate sector, to the startup ecosystem? Honestly speaking, we'll get to know only when they surface. So that, in my view, is the second big risk. So most of the risks we would like to think are global in nature. These are the known unknowns, and obviously we cannot do anything about unknown unknowns. The second point that I would like to make is that even though we are aware of the risks, we might not be able to necessarily act on them even after we get to know them. So now let's take a few examples. So when the Russia-Ukraine conflict started, if in my wisdom, I had decided that this is the first time that a conflict has started in the developed world in a long time, a nuclear power is involved, let us sell everything or reduce risk, we would have perhaps missed the rally for the next 2.5 years, right? Or if, let's say, after the regional banks crisis in the US, in the Jan-March quarter of 23, in my wisdom, if I decided that, this is a beginning of something like 2008, and one had kind of started to wind down positions, then again, one would have missed the rally of the next 1.5 years. So in equity markets, we have to see, even when risks materialize, we just have to wait, watch, evaluate, keep a tab, and then decide. We cannot act in a hurry. So this is not to say that one should not be cognizant of the risks, aware of the risk, or not mindful of the risks, but the actions associated with the risks need to be more measured, tempered, and thought through over a period of time. The third point that I would like to make is that there's a risk on the other side also, the risk of opportunity loss. All of us are really worried about market levels because they are at all-time highs, etc., which is very fair and should be the case. At the end of the day, we should always be mindful of what the price that we are paying to buy. But let's imagine we are in 2020 or 2021. Did we know that we would be here in 2024? At least I didn't know that, right? Even if we were in 2022, let's assume this conference is happening, did we know where we would be in 2024? The answer is no, right? So the risk is on the other side as well. Perhaps we don't know what is in store for the next 2-3 years. So there's an opportunity cost of missing out as well. So we need to be cognizant of both risks, in my view, and not only on of one-sided risks.
Interesting points. Madan, do you agree or you have a different take?
I have a very different perspective of this risk. I think the biggest risk which is facing the investor today is a possibility that markets can consolidate, or probably large segments of the market can consolidate for a very long period. To put it in a simple term, if you had bought into narratives and thematics and all these areas which have seen massive flows and also have illiquid sort of opportunity, you run a risk that for next 3-4 years you might actually not even generate a deposit return in those. I will give you some example and related to recent ones and the little later ones. If in 2022, if you remember, IT sector got the benefit of this global cloud and all these issues. So you had seen stocks like Tata LXI and Happiest Minds trading at almost 60-70 times P ratio. CafeAlt' also traded at such high valuations, but only the CafeAlt' had an earnings benefit. Tata LXI and Happiest Mind normalized those earnings, and since then they have not generated any returns. And this basket has just got more, and the list has become much more in the last 1 year because of the government narrative and a lot of money getting into mid and small cap. And most of this government narrative stocks are in mid and small cap. So they got continuous benefit of flows, and the typical mistake an investor or a fund manager makes during those periods is the money, when he sees that stocks are moving, it gets reinforcing that as if is on the right track. That mistake leads to thinking that a lot of these are structural. Many of the things that happen in the economy is cyclical. Very few are structural. So there will be a tendency to overestimate the growth as well as the growth rate. When the growth rate normalizes, you will have many more, like even before COVID, people justified Nestle's valuation, Asian Paints valuation. But then after that, no returns for last 3 years in Nestle or even HL, as recent as last 6 months gave some returns. But there is a tendency to overestimate growth, and growth rate happens in a bull market, both the side when it happens. So I think that is the biggest risk that an investor faces today. While getting into this momentum and herd mentality, he might end up having certain segments of the market which might not deliver any return for next 3 years meaningfully.
A very important point you touched upon about difference between structural changes and cyclical changes, because cyclical changes will keep on happening, but structural changes are more long-term in nature, and we generally don't identify them.
In fact, Munish, I would like to add a small anecdote on what he just said, that the brain tends to always extrapolate, right? I mean, we just keep on extrapolating the trend ad infinitum. So this was when I was on the sell side, and I had taken my real estate analyst to meet a very respected fund manager. This was 2015. And he opened his model. He said, show me a model. So opened his model, and they were looking at the numbers. I had numbers till 2025. So he said, why did you stop at 2025? Why didn't you extend it even further? So he jokingly remarked, sir, I ran out of columns in my Excel.
That's true. In the paucity of time as well, if we can just take 1 minute each about what are you doing in your portfolios to de-risk yourself? I think in just a short sentences, if you can share, starting with Dhiraj yourself.
So I think Madan makes a very valid point here. You have to differentiate narratives versus numbers. So narratives are important. Narratives can take valuation to 3, 5, 7 sigma above what the so-called line of best fit or so-called fundamentally derived valuation is, provided earnings momentum supports it. So valuation I always call as the second derivative, d2y by d2x. It races faster than the earnings growth, but earnings growth has to be there. So to de-risk from this potential environment, we are currently focusing very hard on where the earnings momentum continues to be strong and where it is showing some signs of weakening. And it is not just earnings actually dipping, which is decelerating, but even the growth rate coming down. even the marginal growth rate coming down can push the valuations down, especially from such elevated levels. So focusing more on where there is acceleration and trying to defocus where there is risk of deceleration. So at this point of time, we are sensing a small mid-cycle reversal. Maybe it's a large mid-cycle reversal, favoring consumption, because that's one sector which is showing some signs of an uptick after underperforming for 3 or 4 years. And similarly, all the capex-related trend is showing some signs of a downtake, or as again Madan says, growth normalization, at least in the near term. So that's how we're trying to balance the risk in our portfolios.
Sandip, changes in your strategy?
Sure. So, the manufacturing sector, we believe, is clearly poised for very strong growth over the next many, many years. Maybe it's going to be a similar cycle that we saw in the IT sector from late 1990s, mid 1990s till 2020, or maybe the private banking cycle from, again, from early 2000s or late 1990s till 2020. So just to give you some numbers, the size of the Indian manufacturing sector is about $500 billion. And that of China is around 10 times that number. So if there's a 10% shift from China to India, we essentially grow by 100%. If that shift happens over a period of 5-6 years, I'm not saying it will, just to put some numbers, that implies a real growth of around 15-16%. Obviously, it's going to be a journey. It's not going to happen in a hurry, and there's a long distance to travel, but we are really bullish on the entire space, and any success requires good luck, and maybe that good luck has come to India because of global diversification of supply chains and people wanting to move away from China, Europe +1 or whatever. So on the back of manufacturing, we are really interested in the infrastructure space, the energy space. So these are the spaces which we are really bullish on, and a lot of the portfolio actions are around that.
And finally, Madan, any de-risking or any change in portfolios?
De-risking we do basically by using a bucketing approach. We have a allocation towards opportunistic ideas depending upon earnings surprise, and we have allocation towards companies which can grow next 3-4 years at least 20% growth. So a bucketing approach. So we shift this bucket depending upon the opportunity that we get, so that a bucket is little more skewed towards opportunities right now, and we will slowly bring it back more towards 20% growth. From a sectoral perspective, right now we spend a lot of time researching on a sector where we really feel that this is something which is happening after decades of struggle, energy transition. You can bet that next 5 to 10 years, you will see in India as well as globally, 2 things happening because of the affordability increasing. So for a very long period, we talked about climate change and all, right? Solar penetration. The only country which has made this possible is China, because the solar cells have come down such a low price. Same period, even battery prices have come down. So this is the first time 2 major energy demand areas, which is power as well as the mobility, can actually get into a transition and adopt more cleaner technology, because both have become very affordable. You would have seen Tata Curve launch last week. It was launched at almost the same price or even lesser than the petrol price variant. If the capital cost is same for a car, EV car, then the running cost, no debate. It is 10% of the cost of petrol. So you can expect EV penetration from 2% to 20% happening in India, and same period, a lot of renewable push happening. That looks very possible. So this is area where we spend a lot of time right now to identify ideas structurally.
Very different approaches, and thank you so much for sharing your thoughts. And don't look at just narration, look at numbers, look at the cyclicality, look for structural changes, and also look for certain gaps which we see in the future about interest rate changes and yen carry trade, conversion happening. Thank you so much for your time, and I hope everybody had a bit snippet of what is going on in the fund manager's mind these days. Thank you so much, everybody. Thank you.